It begins quietly with subtle signs of instability. Consumer confidence falters as job security wavers and corporate earnings decline. Housing markets soften, stock prices begin to wobble, and debt defaults rise. At first, the warning signs are easily dismissed, but economic fragility is deeper than anyone realizes. A series of shocks, financial mismanagement, geopolitical tension, and market overleverage, trigger a collapse of confidence, sending the United States into an economic freefall reminiscent of the 1930s Great Depression. The first signs appear in the financial sector. Banks, overleveraged and exposed to risky loans, begin to fail. Depositors rush to withdraw savings, creating a wave of bank runs. Lending freezes, credit dries up, and both businesses and households find it impossible to access capital. The Federal Reserve attempts to intervene, lowering interest rates and injecting liquidity, but confidence has evaporated. Trust, once the bedrock of financial markets, is shattered. Stock markets respond with panic. The Dow Jones Industrial Average, S&P 500, and NASDAQ plunge as investors flee equities for safe havens. Margin calls exacerbate the sell-off, triggering further market collapse. Companies reliant on stock financing struggle to survive, and corporate defaults increase. ETFs and mutual funds with broad exposure experience cascading losses, and retirement accounts tied to equities are devastated. Investor psychology turns pessimistic, and the volatility index skyrockets. Employment becomes the next casualty. Businesses, facing collapsing demand and credit shortages, initiate mass layoffs. Unemployment surges from single digits to levels unseen since the 1930s. Manufacturing plants close, service industries shrink, and agricultural sectors experience price shocks due to declining purchasing power. Millions of workers lose wages, benefits, and job security, fueling a downward spiral in consumer spending. Consumer behavior shifts dramatically. Households fearful of further income loss reduce spending to essentials only. Retail, hospitality, and leisure sectors collapse as demand evaporates. Foreclosures rise as mortgage payments go unpaid. Rental markets experience similar distress, with landlords unable to maintain properties and tenants unable to pay rent. Hunger, housing instability, and financial insecurity spread throughout urban and rural areas alike. The housing market suffers catastrophic losses. Prices plummet as foreclosures and distressed sales flood the market. Homeowners face negative equity, while construction halts due to declining demand and financing constraints. Mortgage-backed securities, previously considered safe investments, implode in value. Real estate investment trusts, banks, and investors all face massive losses, reinforcing the broader economic collapse. Corporate America faces systemic strain. Companies across all sectors experience revenue collapse and operational disruption. Small and medium-sized enterprises, particularly vulnerable to credit shortages, fail in large numbers. Large corporations struggle to maintain payroll, supply chains, and production schedules. Bankruptcy filings surge, legal systems are overwhelmed, and corporate restructuring becomes the norm rather than the exception. Government intervention is swift but strained. The federal government attempts emergency fiscal stimulus through deficit spending, unemployment relief, and public works programs. However, with tax revenue plummeting and public debt soaring, government capacity is severely limited. Social safety nets are stretched to breaking point, while bureaucratic inefficiencies slow response time. Political pressure intensifies as citizens demand immediate solutions. Public services deteriorate. Education, healthcare, infrastructure maintenance, and social programs experience severe budget cuts. Public employees face layoffs or wage reductions, and essential services operate under resource constraints. Citizens struggle to access education, medical care, and transportation. Urban centers face heightened stress as social unrest grows in response to declining public support systems. Agricultural sectors experience profound disruption. Farmers face collapsing commodity prices, reduced access to credit, and widespread defaults on loans. Supply chain disruptions prevent efficient distribution, while international demand declines due to global economic contraction. Rural communities dependent on farming see unemployment rise and social conditions deteriorate. The agricultural collapse contributes to rising food insecurity nationwide. Financial markets spiral further. With systemic bank failures, collapsing corporate profits, and mass defaults, market confidence reaches historic lows. Securities tied to real estate, banking, and consumer spending experience severe losses. International investors reduce exposure to U.S. assets, creating currency volatility and increasing borrowing costs. Stock indices fluctuate wildly, reflecting both panic and uncertainty about the depth of economic distress. Unemployment compounds social unrest. Joblessness fuels protests, strikes, and civil unrest as communities struggle to cope with economic hardship. Urban areas face heightened crime rates, homelessness rises, and local governments are forced to deploy emergency services amid widespread civil tension. Social cohesion deteriorates, amplifying economic instability. Small businesses, traditionally the backbone of local economies, face disproportionate impact. Reduced consumer spending, limited access to credit, and rising operational costs force many to close permanently. Local economies contract, municipal tax revenues fall, and services are curtailed. The loss of small business activity compounds unemployment and reduces community resilience. Corporate supply chains unravel. Manufacturing, transportation, and retail networks face severe disruption as demand collapses and credit becomes scarce. International suppliers reduce exports to the U.S., creating shortages in consumer goods, raw materials, and industrial components. Production halts cascade across sectors, amplifying economic contraction. Public infrastructure experiences indirect consequences. Reduced tax revenues limit the government's ability to maintain roads, bridges, public transit, and utilities. Deferred maintenance increases the risk of service failures, accidents, and operational inefficiencies. Urban and rural areas alike suffer from deteriorating infrastructure, further hindering economic recovery. International trade contracts sharply. With U.S. demand plummeting, global partners face reduced exports and revenue loss. Supply chain disruptions extend beyond national borders, affecting manufacturing hubs, shipping companies, and commodity markets worldwide. Nations reliant on U.S. trade experience recessionary pressures, creating a domino effect in the global economy. Monetary policy struggles to regain efficacy. With deflationary pressures mounting, traditional tools like interest rate cuts have limited impact. Credit contraction persists despite quantitative easing efforts, and inflation remains unpredictable in certain sectors due to supply shocks. The Federal Reserve is forced to experiment with unconventional monetary interventions, often with uncertain results. Energy and commodity markets are destabilized. Oil, gas, metals, and agricultural commodities experience price volatility due to collapsing demand. Energy producers scale back operations, resulting in layoffs and reduced investment. Commodities trading faces systemic disruption with both domestic and international markets affected by U.S. economic contraction. Insurance and risk management sectors are strained. Property, casualty, and life insurance companies face unprecedented claims amid defaults, bankruptcies, and civil unrest. Premiums rise sharply while coverage becomes more restrictive. Firms reassess exposure to systemic risks, and the cost of doing business increases across industries. The technology sector experiences both disruption and opportunity. Corporate investment in innovation slows due to uncertainty and cost-cutting measures. Simultaneously, demand for efficiency-enhancing tools, digital finance platforms, and remote work solutions grows. Tech companies face pressure to innovate under financial constraint, reshaping the competitive landscape. Consumer behavior evolves rapidly. Frugality dominates as households prioritize survival over discretionary spending. Hoarding of essential goods occurs in some areas while others face shortages. E-commerce, barter networks, and community-based resource sharing increase in prevalence. Traditional retail experiences collapse while adaptive businesses explore new models for survival. Stock market recovery is slow and fragile. Indices reflect ongoing uncertainty, with investor confidence tied closely to employment data, corporate earnings, and government policy effectiveness. Volatility persists as markets adjust to new economic realities, with long-term investment strategies reevaluated. Hedge funds and institutional investors shift toward conservative asset allocation. Corporate mergers, acquisitions, and investments slow dramatically. Capital-intensive projects are delayed or canceled as financing becomes scarce. Companies prioritize liquidity and survival, reducing strategic growth initiatives. International competitors take advantage of U.S. market weakness to capture market share in key industries. Global financial institutions recalibrate risk. Banks, investment funds, and multinational corporations adjust exposure to the U.S., reducing reliance on American consumer demand and currency stability. Credit ratings for U.S. debt are downgraded, increasing borrowing costs. International economic influence of the United States diminishes as other nations gain relative stability. Social inequality intensifies. Wealth disparities widen as individuals with financial assets preserved through other means maintain stability, while working-class and middle-class households face economic devastation. Public unrest grows, fueling political instability and social tension. Long-term societal consequences include reduced social mobility, increased poverty, and diminished public trust. Public debt soars. Emergency spending programs, bailouts, and unemployment relief increase federal borrowing. Interest payments on public debt rise as revenue declines, creating a compounding fiscal crisis. Future generations inherit substantial debt burdens, influencing long-term economic planning and policy options. Education systems are disrupted. School closures, funding cuts, and reduced access to educational resources hinder learning. Universities face enrollment declines and reduced endowment performance. Workforce development suffers, creating long-term skill gaps that impair future economic recovery. Healthcare systems experience immense pressure. Reduced funding, increased unemployment-related health crises, and strain on hospitals create public health challenges. Preventive care declines, chronic disease management suffers, and mortality rates increase in vulnerable populations. Social unrest exacerbates healthcare delivery problems. Transportation networks face disruption. Reduced consumer activity and corporate contraction decrease demand for commercial transport. Freight companies face declining revenue while infrastructure maintenance budgets are slashed. Public transit systems experience service reductions, reducing mobility for urban populations. Agricultural markets face collapse. Farmers struggle with declining demand, volatile commodity prices, and supply chain disruption. Export markets are reduced as international demand weakens. Rural economies dependent on agriculture face unemployment, poverty, and migration pressures. Government subsidies are insufficient to fully stabilize production. Corporate debt crises proliferate. Leveraged companies are unable to service debt amid declining revenue and market instability. Defaults increase, banking losses mount, and legal systems become overwhelmed with bankruptcy proceedings. Corporate governance faces unprecedented stress. Social unrest and civil tension rise. High unemployment, declining public services, and income inequality fuel protests, strikes, and localized conflicts. Urban centers experience heightened security concerns, while rural areas face economic abandonment. Political polarization intensifies, further complicating recovery efforts. Global economies face ripple effects. Reduced U.S. demand impacts international trade, investment, and supply chains. Commodity prices fall, manufacturing hubs slow production, and global financial markets experience volatility. International investors reassess risk exposure to U.S. markets, creating capital flight and currency instability. Ultimately, a second Great Depression in the United States is catastrophic in scope. Stock markets collapse, unemployment skyrockets, consumer confidence evaporates, and corporate America faces unprecedented disruption. Government intervention is constrained, social unrest grows, and international economic influence diminishes. Recovery, when it comes, is slow, painful, and requires decades of structural reform, policy innovation, and societal adaptation. The story of a U.S. Great Depression redux underscores the fragility of economic systems, the interdependence of industries and government policy, and the profound consequences of systemic failure. It is a reminder that economic resilience, diversification, and strong institutional frameworks are essential to prevent catastrophic collapse.